Tax-advantaged accounts like IRAs and 401(k)s are popular tools for saving and investing because they offer significant tax benefits. However, while these accounts can help you grow your wealth more efficiently, they also come with certain risks that are often overlooked. In this video, we'll explore the biggest risks associated with tax-advantaged accounts, helping you make more informed decisions about your financial future. Let's start by understanding what these accounts are and why so many people use them. Tax-advantaged accounts are designed to encourage saving for retirement or other specific goals by offering tax breaks. Common examples include traditional IRAs, Roth IRAs, and 401(k) plans. These accounts can reduce your taxable income or allow your investments to grow tax-free. While the benefits are clear, it's important to remember that these accounts are governed by strict rules and regulation. Failing to follow these rules can lead to unexpected penalties and taxes, which is one of the main risks we'll discuss. One of the first risks to be aware of is exceeding contribution limits. Each tax-advantaged account has annual limits on how much you can contribute. For example, IRAs and 401(k)s have set maximums that change periodically. If you contribute more than allowed, you could face excise taxes and be required to remove the excess contributions. It's crucial to keep track of your contributions each year to avoid these costly mistakes. Another significant risk is the penalty for early withdrawals. Most tax-advantaged accounts are intended for long-term savings, so taking money out before a certain age, usually 59.5, can result in a 10% penalty on top of regular income taxes. There are some exceptions, but in general, accessing your funds early can be very expensive. This makes it important to only contribute money you won't need until retirement. Certain accounts like traditional IRAs and 401(k)s, you must start taking required minimum distributions, RMDs, once you reach a specific age, currently 73. Failing to take your RMD can result in a hefty penalty, up to 25% of the amount you should have withdrawn. This rule can catch retirees off guard, especially if they forget or are unaware of the requirement. Planning ahead is essential to avoid unnecessary penalties. Tax-advantaged accounts often come with limited investment options, especially employer-sponsored plans like 401(k)s. You may be restricted to a set menu of mutual funds or other investments chosen by your employer. This can limit your ability to diversify or pursue certain investment strategies. It's important to review your options carefully and understand how these limitations could impact your long-term return. Tax laws are subject to change, and what's advantageous today may not be tomorrow. Congress can alter contribution limits, tax rates, or withdrawal rules at any time. This uncertainty makes long-term planning more challenging. While you can't predict the future, staying informed about potential changes and being flexible with your strategy can help you adapt if the rules shift. Tax-advantaged accounts are governed by a complex set of rules. From eligibility requirements to contribution deadlines and withdrawal restrictions, it's easy to make mistakes. Misunderstanding the rules can lead to penalties, lost tax benefits, or even disqualification of your account. Consulting with a financial advisor or tax professional can help you navigate these complexities and avoid costly errors. While tax-advantaged accounts can lower your taxes now, you may face higher taxes in retirement. For example, withdrawals from traditional IRAs and 401(k)s are taxed as ordinary income. If tax rates rise or your income is higher in retirement, you could end up paying more than expected. It's important to consider your future tax situation when choosing between different types of accounts. Money in tax-advantaged accounts is generally less accessible than in regular savings accounts. Early withdrawals often come with penalties, and there are restrictions on how and when you can use the funds. This lack of flexibility can be a problem if you face unexpected expenses or need cash quickly. Always balance your retirement savings with enough liquid assets for emergencies. Choosing the wrong beneficiary or failing to update your beneficiary designations can create problems for your heirs. If your account doesn't have a valid beneficiary, it may go through probate, causing delays and potential tax issues. Regularly review and update your beneficiary information to ensure your assets are distributed according to your wishes. If you have a 401(k) with your employer, there's a risk, however small, that your employer could go bankrupt. While your 401(k) assets are generally protected, issues can arise if the plan is not managed properly or if there's fraud. It's wise to monitor your account statements and understand your rights as a plan participant. Just because your account is tax-advantaged doesn't mean your investments are risk-free. The value of your investments can go up or down and you could lose money. It's important to diversify your portfolio and choose investments that match your risk tolerance and time horizon. Many tax-advantaged accounts come with fees such as account maintenance fees, fund management fees, or transaction costs. Over time, these fees can eat into your returns. Always review the fee structure of your account and look for low-cost investment options to maximize your growth. Some 401(k) plans allow you to borrow from your account, but this comes with risks. If you leave your job or can't repay the loan, the outstanding balance may be treated as a distribution, triggering taxes and penalties. Borrowing from your retirement savings should be a last resort, not a regular strategy. Roth IRAs have income limits for contributions. If your income exceeds these limits, you may not be able to contribute directly to a Roth IRA. Attempting to do so can result in penalties. There are workarounds like the backdoor Roth, but these can be complex and require careful planning. Certain transactions are not allowed in tax-advantaged accounts, such as using your IRA to buy property for personal use. Engaging in prohibited transactions can disqualify your account and result in taxes and penalties. Always check the rules before making unusual investments or transactions. If you inherit a tax-advantaged account, you may face complicated rules about how and when you must withdraw the funds. The Secure Act changed many of these rules, requiring most non-spouse beneficiaries to withdraw the entire account within 10 years. Failing to follow these rules can lead to penalties and unexpected taxes. Not all states treat tax-advantaged accounts the same way. Some states may tax your retirement distributions even if the federal government does not. It's important to understand your state's tax laws and factor them into your retirement planning. Unlike taxable investment accounts, tax-advantaged accounts do not receive a step-up in basis at death. This means your heirs may have to pay taxes on the full amount when they withdraw the funds. Understanding this difference can help you plan your estate more effectively. In rare cases, you could face double taxation. For example, if you contribute after-tax dollars to a traditional IRA and don't track your basis, you might pay taxes again on those contributions when you withdraw them. Keeping good records is essential to avoid this risk. While some tax-advantaged accounts offer protection from creditors, the level of protection varies. For example, 401(k)s are generally protected under federal law, but IRAs may only be protected up to certain limits. Knowing your account's protections can help you safeguard your assets. Rolling over funds from one tax-advantaged account to another can be complicated. If you don't follow the rules, you could trigger taxes and penalties. For example, missing the 60-day deadline or making more than one rollover per year can cause problems. Always consult a professional before initiating a rollover. Assets in tax-advantaged accounts can affect your eligibility for financial aid if you or your children apply for college assistance. While retirement accounts are often excluded from aid calculations, withdrawals can count as income, potentially reducing aid eligibility. Plan carefully if college is in your future. In the event of a divorce, tax-advantaged accounts may need to be divided. This process can be complicated and may require a court order, such as a Qualified Domestic Relations Order (QDRO) for 401(k)s. Mistakes in dividing accounts can result in taxes and penalties, so it's important to handle this process carefully. Unfortunately, tax-advantaged accounts can be targets for fraud and scams. Phishing emails, fake investment opportunities, and identity theft are all risks. Always verify the legitimacy of any communication about your account and use strong security measures to protect your information. Many employers offer matching contributions to 401(k)s, but these matches often come with vesting schedules. If you leave your job before you're fully vested, you could lose some or all of your employer's contributions. Understanding your plan's vesting rules can help you make better career and financial decisions. Market downturns can significantly impact the value of your tax-advantaged accounts. While these accounts offer tax benefits, they don't protect you from investment losses. Diversifying your investments and maintaining a long-term perspective can help you weather market volatility. Some investors put too much of their retirement savings into a single stock, often their employer's stock. This overconcentration increases risk as your financial future becomes tied to one company's performance. Diversification is key to reducing this risk and protecting your retirement. Inflation can erode the purchasing power of your retirement savings over time. Even with tax advantages, if your investments don't keep pace with inflation, you may find your money doesn't go as far in retirement. Consider including assets that historically outpace inflation in your portfolio. Tax-advantaged accounts are designed for long-term savings, so accessing funds before retirement is difficult and often expensive. This lack of liquidity can be a problem if you need cash for emergencies or opportunities. Always maintain a balance between retirement savings and accessible funds. Managing tax-advantaged accounts often involves filling out complex forms, such as IRS Form 8606 for non-deductible IRA contributions. Mistakes on these forms can lead to tax problems or missed benefits. Double-check your paperwork or seek help from a professional to ensure accuracy. Each tax-advantaged account has specific deadlines for making contributions. Missing these deadlines means losing out on valuable tax benefits for that year. Mark your calendar and plan ahead to ensure you maximize your contributions before the cutoff date. Converting a traditional IRA to a Roth IRA can be a smart move, but it's complicated. You'll owe taxes on the converted amount, and timing is crucial. Mistakes can lead to higher taxes or missed opportunities. Consult a tax professional before making a conversion. If you're too conservative with your investments in tax-advantaged accounts, you may miss out on potential growth. While it's important to manage risk, being overly cautious can result in lower returns and less money in retirement. Find a balance that matches your goals and risk tolerance. Tax-advantaged accounts often require you to provide disclosures about your investments and account activity. Failing to provide accurate information can result in penalties or lost benefits. Stay organized and respond promptly to any requests from your account provider. Withdrawals from tax-advantaged accounts can affect your eligibility for government benefits like Medicaid or supplemental security income. These withdrawals may count as income and push you over eligibility limits. Plan your withdrawals carefully if you rely on these programs. Some tax-advantaged accounts require you to aggregate balances or distributions for tax purposes. For example, the IRS may require you to combine all your IRAs when calculating RMDs. Failing to follow aggregation rules can result in penalties or incorrect tax filings. Contributing more than the allowed amount to your tax-advantaged account can result in penalties and taxes. The IRS imposes a 6% excise tax on excess contributions each year until the excess is removed. Double-check your contributions to avoid this costly mistake. If you don't contribute enough to your 401k, you may miss out on your employer's matching contributions. This is essentially free money for your retirement. Make sure you understand your employer's match formula and contribute enough to get the full benefit. Failing to contribute to a traditional IRA or 401k before the deadline means missing out on valuable tax deductions for that year. These deductions can lower your taxable income and boost your savings. Mark your calendar and plan your contributions to take full advantage. If you don't use tax-advantaged accounts, you may miss out on the benefit of tax-free or tax-deferred growth. Over time, this can make a big difference in your retirement savings. Make sure you're taking advantage of all available options to maximize your long-term growth. If you're age 50 or older, you can make catch-up contributions to many tax-advantaged accounts. Missing these extra contributions means missing out on additional tax benefits and retirement savings. Be sure to take advantage of catch-up opportunities if you qualify. Forgetting to take your required minimum distributions can result in steep penalties. The IRS imposes a penalty of up to 25% of the amount you should have withdrawn. Set reminders and plan your withdrawals to avoid this costly mistake. Tax-advantaged accounts offer powerful benefits for building wealth, but they come with a range of risks that can undermine your financial goals if you're not careful. By understanding these risks and staying informed about the rules, you can make the most of your accounts while avoiding costly mistakes. Regularly review your accounts, consult with professionals when needed, and keep your long-term goals in mind. With careful planning, you can enjoy the advantages of these accounts and secure your financial future.